whether they want to find a fund to work with, they want to find co-investments that are later stage that they can trust, or they just want some advice. I run a 2-hour show on Clubhouse answering just general space finance questions. And we get family offices and individual investors coming in asking questions all the time. Happy to answer those. You do not have to be an LP for us to help you out from making a mistake. So just let us know.
Great, thank you. Avi?
So the question is, how do we help family office, and what is our particular niche? Yeah,
correct.
So for us, I think, you know, we are very focused on identifying large markets, whether that be consumer markets like food and agriculture, or healthcare or mental wellness, and applying deep technology, data, you know, analytics, you know, and various kind of new platforms to, you know, essentially our focus is on applying technology to kind of empower people, and to as a core element of the approach. So we're very much focused on going into different markets where we see inefficiencies, and we then, both in terms of, you know, kind of structural and business elements, but then also in terms of developing specific technology, you know, around new kinds of models and approaches. You know, that's where the two things blend. So a few examples are, you know, kind of in the food technology space. We're using data and kind of new machine learning algorithms to provide working capital loans to farmers in Brazil. So that's an example of a very large market, very underserved, especially for small and medium farmers. And it allows us to look at everything from supply chain to kind of, you know, consumer credit, all of those things with new kind of, you know, modeling approaches. And we partner with sometimes, you know, very large existing industry players in these startups. So our focus as far as providing capital is that we kind of bridge that early stage kind of risk for investors. A lot of times we come in very early around kind of presentation stage, ideation. We help with the creation of the model, the platform, you know, almost serving, you know, as a kind of a founding team member and board member, and especially in some emerging markets, it's very important to de-risk the investment. So we've done that now kind of in various markets in the world, and we'll partner with both local family offices and also international investors, co-investors at the right stage. A lot of times we'll partner with local family offices first, bring them in, you know, and kind of create a you know, a success story, a best practice, and then we kind of raise capital later down the road to scale. So I think what we bring to family offices in our network, we have quite a few co-investors that are leading families in different regions. We bring them kind of ready-made deals and applications of technology that are proven that they can understand with a market focus from a business standpoint. And then we bring that to them, and then they can participate with us. You know, we have a very flexible capital structure in the Isle of Man. That's where our vehicle is based. So we can kind of create SPVs and bring in partners fairly easily into deals. And we've done that dozens of times. So that's kind of how we bring these projects to our partners.
Great, thank you. So one of the things that I'm assuming, right, is that the application of your technologies doesn't just occur in a silo, right? Space isn't just confined to space. You know, how, you know, when you're looking at the supply chain from the start to from the cradle to grave, I guess what they say, how is the implementation of your specific, you know, technologies that you guys are working on or investing in, how does application impact both upstream and downstream users, you know, so it isn't built in a silo?
That's one of the things that we have to spend a lot of time looking at in the space sector. Is this is a new sector, and there's a lot of people that came out of the previous aerospace supply chain, where generally you only have one what we call ultimate customer. It was probably either Boeing, Lockheed, or Northrop Grumman, and it's because of that some of the companies that sell into the supply chain are not used to actually real commercial applications in the upstream. And so they're not able to create any cost efficiencies. Acquisitions in those spaces are maybe 1.5, maybe 2x revenue. So there's not a lot of investment opportunities. These are usually family-run businesses. And there's a lot of change going on right now. There are some opportunities in private equity roll-ups of some of these companies, but those are proving to be very difficult because you have to re-engineer these companies from scratch. On the downstream side, you have to do a company has to do a lot of education on the capabilities to be able to sell outside the space sector. So it's fairly easy to go to either NASA or DOD and say, I want to build an Earth observation satellite. And they go, yeah, we get that all day long. We're ready to buy, let's go. If you're trying to sell commercialized weather forecasting, which is actually a thing. There are commercial weather companies out there with their own weather radar satellites that do sometimes better than even NOAA does. Educating their customers about the capabilities makes for sales cycles to be fairly long. And that's one of the challenges, is educating the non-space sectors about the capabilities and packaging those capabilities into something that solves non-spacey, non-science fiction-y kind of problems. We're doing that, but it's an education process we have to go through.
Darryl, what are you seeing?
What I find is that when I'm advising my clients who are looking at a particular investment is, and I think what Avi said is just so true, is how do you de-risk the potential investment that you're looking at? Sometimes they fall in love with the founder, if you will, but the founder hasn't really thought about the commercialization of the product, good, or service, mainly the application that they built. And again, getting back to what problem is it solving, and how big is that problem, which means, okay, what is the market willing to pay for it, and where does it fall along that Rogers curve in regards to the early adopters, the innovators, and the laggards. So I spend a lot of time guiding them through this thought process and getting them to understand the technology in layman's terms, if you will. Because a lot of times what I find is that sometimes these founders, they're very bright people, but they've fallen in love with their application, and everything is easy. But guess what? Life is hard. Technology is hard, and that I get very skeptical when I hear someone say, "Oh yeah, it's real simple, it's real easy." No, it isn't. When you're looking to do very sophisticated things with blockchain and AI, it requires deep thought, and again, very bright IT folks, very technicians, data scientists.
Great, thank you. Avi.
Yeah, I think in addition to what the others have said, one approach that I found very successful is the idea of having kind of an innovation customer along the journey with companies, because you do need kind of these visionary founders a lot of times with truly disruptive technologies. We've invested in some game-changing robotics companies with space application, but other applications as well. It's very hard to, as others have said, it's very hard sometimes to kind of explain the benefits and sell the benefits of a particular technology before it's actually in the market. So you kind of get into a catch-22. So finding a champion at a very large company that can come along the journey with you at early stages. We've done this now with a global top 50 company with a kind of AI insight, mining company for a research application. Having that commercial thought in everything from design to use to feedback and kind of bringing that industry advisory panel together, we found very important. I think also, having the right balance of investors around the table to kind of check the impulses of founders is very important. Understanding sometimes the journey of taking a product to market. It's sometimes building it all at once is not, the whole vision is not the actual solution. You can take things piecemeal. You can bring things in stages. You know, looking at the spending at early stages, I think is important. So those are some of the things that I've learned, you know, to bring in very strong co-investors. I have certain funds that I like to bring at early stage that trust me, who bring kind of an institutional credibility in evaluating early stage projects and putting in place some of the controls and milestones and things like that. So that helps me because, you know, we don't have as institutional of a structure. So that's on the investor piece. But yeah, and just understanding that the journey to take these things to market takes time. You know, everybody, you know, thinks that the vision is just going to take off, but there's a lot of education that has to happen. You know, whether you're selling into a corporate environment or to consumers, you know, a lot of times there's a lot of education, and things can kind of take off, you know, at a time where they hopefully will take off sometime, but you need to, I think there needs to be patience because it's not always predictable about when that, you know, inflection point will be reached with something. So those are the kind of considerations I think that are important. Patient capital, I think, is incredibly important for early stage. We've been on 6-year journeys with companies before we, you know, really see that inflection point. So, yeah.
I just like to build on what Avi said in regards to patient capital, is that if you set the performance metrics and you can measure it, that gives the investor, the family office, more comfort, if you will, if folks are meeting their particular milestones, or if there's a blip in the milestone, what happened there. That type of transparency and communication goes a long way to providing more comfort and more information to the investor. Investors, they just become more, they feel that the founders become more credible, if you will.
So I wanted to follow up on that. Both of you said that, you know, mentioned that it's complicated. It's not easy. People want to exit now instead of being patient, and co-investment, right? If you took those together, how can VCs and family offices help, you know, drive these new technologies, these companies, help them build their applications and their process going forward?
Who would you like to kick off?
You kick off?
Okay, I'm happy to.
Great.
Yeah, I think specifically family offices, since that's the focus here. I think there's a significant potential if you can balance the risk appropriately, because patient capital is required for a lot of times. A lot of times family offices come with very large family businesses, you know, behind them. So there's a lot of potential for that co-innovation approach. I've seen that works well. So definitely, you know, having the longer term view, I think is something very beneficial to a startup at an early stage. I think that there's this like kind of ethos that's come out of Silicon Valley that rounds need to be bigger and faster, and companies need to grow in a certain way and look a certain way, which it sounds really good. And certainly, you know, I think we all probably are surrounded by these instant success stories, but actually great businesses can be built around disruptive technology that can take a long time. And it can look different than, you know, they can look very different than like you know, the Uber for X or the Stripe for Y kind of thing. So I think that a lot of times families, I find that we have a private capital base of you know, quite a few different private families. They understand that businesses take a long time and they have a generational approach to things. So that I do think for the right entrepreneurs, it can kind of be a good marriage. So yeah, and I think and I think there's a different kind of skill set of it, you know, that they bring to the table. You know, so that's my thinking on it.
I have to agree because we've got a fair number of crypto related families that's where they made their money, and they understand the transformational nature of certain technologies, but you have to be there, you have to be patient with them. But when things take off, you also have to be aggressive with them and being able to prepare for and look for those market signals. I have, you know, several friends that have been involved in crypto since the, you know, Satoshi Son's paper came out that early. And so it's very, everybody was wondering whether or not they were crazy for buying Bitcoin when it was, essentially a penny or, that kind of level. At the same time, we have another family that's involved in logistics. And so space has a lot of logistical problems to it, and they really understand those. So in a lot of cases, our family offices, because they have experience with building businesses, generally, they bring skill sets that we can bring into some of the companies that we've invested in and say, you should talk to these guys. They actually have gone through this before. They can help you understand where to go. One of the other interesting things that I've seen work in the past is families often have various, especially, when you're second and third generation with the family office, you have large numbers of descendants that are looking for jobs in the technology sector. And just putting in a plug for the space sector, everybody's hiring. We need employees badly. Everything from lawyers to managers, project managers, leaders, everything. So we actually do go out to a lot of our family offices and ask them, do you have anybody that's looking for a job? Because we're hiring.
That's good to know. Daryl.
So yeah, so when you look at where technology has been, where it's going, and Bitcoin is a very good example that started back in 2008 and has grown, and now we're seeing that the legislators are now talking about, okay, so how do we bring stability to, or legislation to these technologies that's going to allow it to flourish even further. And you see that's taken like 15 years. So when you're talking to a family office about an investment, they're very long-term investors, as we all have discussed here. But it gets down to them understanding the technology. When you think about deep tech takes a lot of time to come to fruition. Deep tech solves very, very sophisticated problems, but I feel that if you can articulate how difficult the issue is and what the problem is, and show a critical path to the family office and how this particular technology is going to work towards that, and then of course you're establishing those milestones and they're meeting those milestones, it again, it gives the family office a degree of comfort out there. And there's a lot of examples that we have seen, that we have witnessed about new technology that is just taking time for it to come to fruition. I mean, if you look at the streaming services, HBO, which was in the leader back in 2011, ignored it. And now HBO, now they got a streaming service, but not before Netflix really established himself as a major powerhouse. One other example I love to share is that I always ask the audience, who knows the name Telerate? Now, people in the financial markets who have been in financial markets, they'll know Telerate, but nobody else does. But everybody knows Bloomberg. Well, prior to Bloomberg coming on board, Telerate had 100% of the marketplace. And people ask the question, why does News Corp own the Wall Street Journal? The reason is that the Bancroft family decided to bail out after the Telerate cost them like $2.5 billion in losses. So, but that's where a major corporation like Telerate ignored technology that was right in front of them. And Bloomberg took it over. So it's understanding where's the technology, what is the competitive technologies, and what are the, I guess, the macroeconomics of looking at the different performance metrics of a current technology versus the new technology. And when you start to see that those numbers, or one number is going down, another number is going up, well, that's a good time to hit the marketplace.
Great. So go ahead.
I have actually a quick question for both Avi and Daryl. When to that specific point, how much do you do road mapping for where you think the various sectors are going to be at in the future? We do a lot of
guys,
that.
we have a couple more minutes. Keep on going.
So Michael, the reason why I'm laughing, because I do these roadmaps and I laugh at them a year or two later, because even though I put a lot of thought into it, I put my heart and soul on. I'm on my patio on a Sunday afternoon, telling my wife, yeah, I think I got it. I'm always dead wrong. But am I in the ballpark? Yes. Am I in the right seat? No.
Yeah, just as a quick add on to that, the only thing I have come to know about my best plans is that they're always wrong. So I basically I just kind of look at the kind of the risks and the infrastructure around it, ecosystem, so that as the plan kind of goes, we can just be on an upward trajectory, you know, even if there are some pit stops and things.
Yep. Thank you.
Great. So we have a couple minutes left. Marty, do we have any additional question from you? Is he still there? No. All right. So I have one more. First of all, thank you very. Oh, he's back on. Marty, would you have any?
No, I think you're good. I mean, these are fascinating times. And again, I just think the space program and the direction you guys are going is a huge opportunity. And I know I keep on calling it green fields, but I think it's a one big green fields aspect. And there'll probably be things learned from this program, which will have application on Terran soil. So, you know, so keep on going. One more question.
Awesome. So this is a question I want to ask because, you know, I've read all the books, you know, Start With Why, you know, Simon Sinek stuff, right? In traditional finance, traditional world, companies focused on products and services and just on the products and services and what they offered, right? But you're in, you know, deep tech, which is new, innovative, you know, how big of a role does the purpose of these founders have behind it, you know, moving forward? And what avenues, in addition to just building a product and service, do you see as being important? Is it social capital, or how is it, and how's it playing out? Start, Avi.
Yeah, so for me, it's almost everything. You know, like when I'm partnering with a founder, I look at it as a 10-year plus journey. And so the purpose of that founder, and to me, like a lot of times with these innovative technologies, if you get it right, they have impact just walking out the door. So you don't have to look at it as like an impact investment in order for it to be incredibly impactful. You know, so we have companies that have taken journeys now to take containers and put farms inside of them with, you know, LED technology and hydroponics, and bringing that to market and looking at partnerships with big traditional players. And, you know, maybe one day they will be on Mars, you know. So that's the thing is that we do need to transform the food system. So the ethos of the entrepreneur for me is very important across anything. And, you know, even some businesses that are, you know, even some businesses that sometimes, you know, can fail, you know, it's good to be partnered with the right people, because that is a risk of the journey, hopefully not too often. But if the right purpose is there and the right intent there, usually things come right. So yeah, the purpose is incredibly important for me, and the vision and everything in the founder, in what we do.
Yeah, I think for me personally, I agree with Avi. The mission to try to improve mankind is very important. I'm very heavily involved in scholarly research, having worked at Elsevier in a previous role. It's important that the company has a respect for mankind, humanity, and for our planet. Michael, I don't mean any offense, but I get kind of offended when we're talking about going to another planet, if you will, but meanwhile we're messing up our planet. And I think, I mean, I love, my sister works at NASA at Goddard, and I love space, but let's not destroy what we have. Let's try to do the best we can for our Earth and our planet. And the projects I take on, they're the ones that I'm very passionate about, and the ones that are destructive, I don't get involved in. I choose not to be involved in. Oh, one other thing I want to mention is something that's very important that I work with the folks that I work with is get them to understand the intellectual capital value. That's a whole nother discussion we can have. I'm doing a whole series about that on my radio podcast about intellectual capital. And that's something that I think is an opportunity for investors understand and to look at as well.
Yeah, just to the original question, that I just a quick rejoinder with Daryl there. We actually dig into what the entrepreneur, what their vision is, because sometimes, especially in the space sector and even other deep tech areas, they're almost embarrassed to actually say what their long-term goals actually are, because they don't think that you would believe them. And so one of the things that we spend some time doing is, okay, we know you're talking about this particular product, but I really, really want to know what your long-term vision is, to make sure I know where you are going aligns with what I think you're doing with this particular technology. We have run into, companies that say, yeah, I'm doing this because I want to be able to get enough money from this to go do that. And if this and that are very different, it's kind of causes problems. But when those two things align, you get a company and a company culture that are very dedicated to the long-term growth of the company. And that's what we really look for. In a lot of cases, I've seen entrepreneurs scale their company down to what they think they can raise versus what they think the actual final opportunity might be. And unless you know what that final opportunity is, you may not know what you're investing in. But finally, back to Daryl, we should chat offline one day about all the opportunities that the space has for monitoring climate change. For example, we're an investor in New Age Meats, which is a stem cell-based meat company to get rid of the entire livestock supply chain and actually do better food than we're having now. So yeah, space will save the earth.
Absolutely. Look forward to it, Michael.
Well, great job, guys. Listen, thank you so much. I think we're covering this, and we're going to cover it in more detail in the next year. And we have a Silicon Valley event. We'll probably cover this again. Maybe a couple of you will be repeat speakers. But now we're going to move to real estate and hard assets. Is Elizabeth Avery there? Elizabeth?
I am. Let's see if I can get my my camera on for you.
Perfect. I don't see you right now. It says your camera is on. Now it's
Okay.
off.
All right.
Okay. Now it's back on. So before Elizabeth gets started, Congress just passed this massive spending bill. Whether inflation is going to be transitory or more permanent, I think the big question is, as inflation goes, I think real assets go, because ultimately, there's a real asset. Inflation has to be based on something, and the value of real assets goes up as your currency depreciates, I guess. So actually, we did an event. It must have been like around 2009, 2010. So we had Paul Stevens from Robertson Stevens come and speak, and he was like really furious because of the bailouts in 2008. He's like, I can't believe they wrote like $750 billion of money to the banking system and then another to the European banking system. The Fed's out of control. So I'm investing in hard assets. So his idea was to buy a bunch of walnut farms in California and try to corner the walnut farm market. And then he also invested in something called a Bitcoin mining company, which his two sons led. So the Bitcoin mining company went on to become Blockchain Capital. Bart and Brad Stevens are his two kids. They're very successful because they were buying Bitcoin at $10. So I'm a big, and I also think that these intangible assets are assets. So crypto, coins, Bitcoin. I'm not sure about the tokens. So I'm a big believer in real assets. So Elizabeth, you've got a great panel. I want you to introduce them, and hopefully we can fix your camera problem and go from there. So why don't you kick it off?
Okay. I'm not sure, Marty, why we're having such a challenge here. If you have a recommendation.
No recommendation, just keep on pushing.
Okay, let's see what we can get. I know that I'm currently invisible, but we're going to work through this. My name is Elizabeth Avery, and I'm the founder and managing director at Kalorama Capital here in DC. We were founded for the purpose in 2000 as an SEC licensed broker-dealer focused on alternative investment. And we have worked with everything from emerging managers to global financial institutions. And it's been traditional venture, it's been buyout, and it's also been real estate and direct transactions as well as funds. But while I try to become more visible here, I may have to give you a substitute picture. It says stop video, but it clearly is not video. So if the team would like to lead off, Andy, if you'd like to go ahead
Sure.
and tell us your background.
Yep. Hi. So my name is Andy Weiss. I am the president and founder of Sapphire Capital Group based in Bethesda, Maryland. I've worked in real estate finance for over 30 years as a lender, equity investor, and mortgage banker. Sapphire works on capital raise assignments for commercial real estate owners and developers. We raise debt for all property types, and we're members of a national collaborative of 40 mortgage banking firms, which allows us to share a database, and we invite lenders to present to our group on bi-weekly calls. And then we raise LP and GP equity from family office investors, high net worth individuals, and institutional investors. We work on assignments with sponsors on all property types nationwide. And we developed a niche in ground lease capital that I will talk about in more detail in this session. And I'm excited to be on the panel.
Thanks very much. Doug, would you like to lead off next?
Sure. Thanks, Elizabeth, for moderating. Thanks, Marty, for the opportunity to participate. I'm Doug Veasey, the founder and managing partner of Kenilworth Capital Partners, a real estate investment and advisory firm headquartered in Philadelphia, which I formed several years ago to capitalize on a 30-plus career year in real estate finance and investment as a lender, developer, and investor. Kenilworth provides strategic and capital advice and co-investment capital to high-quality sponsors investing in value-add residential, industrial, medical office, student and senior housing projects on the East Coast, particularly in the Mid-Atlantic and the Southeast. We specialize in small to medium-sized transactions, from 7 to 75 to 80 million in total asset size, ideally suited for family office investors. In fact, of the $350+ million we've been involved in as an advisor over the past 3 years, vast majority has been from of equity capital, both GP and LP capital, as well as preferred equity capital, have come from family office investors. I should also mention that Kenilworth makes principal investments frequently as a co-invest with our clients, as well as some standalone sponsor projects that we're involved in, multifamily side and the industrial side. And I'm happy to be on the panel with these great guys.
Thank you very much. Percy, would you like to fill in the next background for the panel?
Sure. Well, good afternoon, everyone. My name is Percy Nikora. I'm the president of Penn Capital. We are a owner-operator of multifamily properties. We have some mixed use as well. Our focus is primarily in the South and Southeast states of the US. We work very closely with family offices. We obviously invest our own capital, but then we also bring in other capital through LP structures, GP structures, and some of the things we'll get into. But we work closely with family offices, high net worth individuals, as well as institutions. And from a transaction standpoint, our properties range everything from cash flowing institutional class properties, $50 million plus, to smaller value add properties that could be in the $15 million range.
Okay, thank you very much. One of the things we know is on everyone's mind today is what has the pandemic done to the real estate investing market? And then how does that augur for the attempted recovery for 2021, 2022? I know that sometimes looking at the aggregate numbers, it can give the impression that's quite negative. For example, 2 of the leading entities will not be going into the capital raised markets this year. So there are these dire warnings that the numbers will be down. However, the pundits are telling us a different story. For example, Forbes has said that they think that the inflation concerns will actually drive more money into the real estate market. for those of us who follow the private markets through Preqin, for example, they took a survey that was also very positive, that 81% of those they surveyed as investors have said that they think that they will invest as much in real estate and actually perhaps increase the real estate investment for this year. We are hearing a lot about M&A as being a big year, and especially when you see the numbers that came out with Blackstone's acquisition of about 5.1 billion of the assets that we're seeing from AIG. So each one of our panelists, if you can give us some direction, how you see the insights of what we have learned from the pandemic and where we're moving. And secondly, how does this impact the family offices? And Andy, would you like to lead off for us?
Yes. Yep. So I'm going to start first. I'm going to focus on the sort of recap on the different property types, and then the other panelists are going to, add different views on it. So a quick summary of what happened to the major property types as a result of COVID in 2020. So the hotel and retail properties were the most impacted because of the lockdowns. Retail was already impacted by what I call the Amazon effect, pre-COVID. Multifamily properties, suffered a drop in collections as many landlords had tenants in occupancy, but not paying rent. One of the shifts in multifamily that we saw was a shift from urban apartments to suburban, as many people left cities and began to consider, the new norm of working remotely. The office sector, office properties were not occupied by tenants during 2020, and that continues today. As people started to work from home during the beginning of COVID. This has also changed the way some companies think about their need to have office space and new social distancing standards and what they think their post-COVID occupancy plans will be. During 2020, many lenders required COVID reserves and were more conservative in their underwriting. As would be assumed, investors were more conservative with their underwriting. They were unsure about, recovery timing and what would be the new norm for property type. So that's sort of 2020. On the 2021 side, what I would say, much more positive, investment sales have recovered, multifamily, industrial, the two hot property types have been trading at, below 5 cap rates, given the huge demand from investment capital that are looking for good deals. There's also a massive supply of debt with low interest rates. So that's helping investors get comfortable with making investments, in 2021 after a slow 2020. The one challenging issue for most real estate underwriting and investment and lending is the most common financial metric, what we all call the T12, the trailing 12 months of cash flows. That suffered big declines in 2020. So it's just something people have to deal with in 2021 as they're underwriting deals, explaining, the recovery from the decline of the T12 that happened as a result of COVID in 2020, but now, recovering in 2021. And again, I'll just blow through the property types again for where I see things today. Retail and hotel properties, recoveries are still uncertain. On the office side, many companies are now adopting remote working policies, and they're starting to rethink their long-term office space demand. Yesterday, I happened to be listening to Cushman & Wakefield's CEO was on CNBC, and he was talking about his partnership with WeWork, how they have now a new hybrid office model, which creates basically a different tenant experience with the use of technology. And so on the office side, there's clearly a change that is happening and will happen. And last thing I'd say on the multifamily side is, most of the stronger operators have gotten their collections back up. And I'd say the last thing is, the suburbs are still remaining hot. And now the single family rentals is the new, hot sector, as there seems to be a huge demand for single family rentals. So I'll stop there and I'll pass it on to Doug.
Thanks, Andy. The real estate investing life in 2020, for all the reasons that we've talked about and that Andy outlined, was extremely difficult. Needless to say, when the lockdown first started, I checked in with some of my family office investors, and the vast majority of them weren't doing anything in the private real estate space. They were exclusively in the public arena, both on the debt and equity side, taking long and short positions as quickly and as aggressively as they could. They did well, very well for the most part, but there was a substantial lack of liquidity in the private space. That changed with, from my experience, with as people started to get their arms around where their collections and where their business plans were headed. In the sort of March to April and into May timeframe, one of my clients, a logistics company, was expanding aggressively. It was clearly advancing based on the e-commerce growth prior to the pandemic, but the follow-on of the pandemic is that opportunities for them just continue to explode. We had created an alliance with a family office prior to the lockdown, fortunately, that was able to fund their growth all throughout 2020. So this was a infill last mile logistics sponsor and owner in the mid-Atlantic area. Just continued to do a lot of business with family office capital. As the world began to normalize toward the end of the year and the beginning of this year, there was a substantial inflow of family office capital as well as industrial capital into multifamily. A number of my clients are developers, and throughout 2020 had no ability to move things forward based on municipal shutdowns. They couldn't get any of the permits. They couldn't get any traction at all in advancing their projects. That's improved substantially, although in a variety of jurisdictions, there's still a lot of backlog. But for the most part, the multifamily world has continued to improve. Certainly, as Andy pointed out, collections are back up depending on the asset, depending on the location and